Just about to see how much further we can fall. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, futures trimming some losses this morning, but the global market meltdown shows no signs of letting up.
Strategists continue to cut S&P 500 targets while Wall Street billionaires criticize Donald Trump's tariff strategy, with Jamie Dimon calling for a quick resolution.
But the president remains defiant, signaling he won't back down on tariffs, also dismissing fears of inflation and recession.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
Markets could see some relief as tariff negotiations take shape, that according to the White House.
But the fact is the countries are angry and retaliating. And, by the way, coming to the table, I got a report from the USTR last night that more than 50 countries have reached out to the president to begin a negotiation. But they're doing that because they understand that they bear a lot of the tariff.
Bloomberg's Anne-Marie Hordern has been traveling with the president this past weekend. She joins us now from Washington. And I believe it was also on Air Force One that he said, you know, I was elected on this. This was one of the biggest reasons I got elected. Of course, talking about eliminating trade deficits. And Anne-Marie, it's clear that he views this as his mandate and that what's happening in Wall Street right now is just collateral damage.
Yeah, the president is certainly digging in when it comes to his trade policy and doesn't want to relent. What was very clear is when he was talking about China, he said, I'm willing to make a deal with China, but they have to solve the surplus. We have a tremendous deficit problem with China. And you also talk about the deficit problem the United States has with the European Union. That seems to be a line in the sand, a red line for this administration. At the same time, Kevin Hassett, his National Economic Council director, was on talking to reporters again earlier this morning, making similar comments he made over the weekend. The fact that more than 50 countries have called the White House, are reaching out to the administration to try to get to a deal, which leaves us with this morning this question we have on whether or not this is a pure negotiation, or are these the new rules of the road, rules of trade, complete global realignment? I did try to ask the president that yesterday on Air Force One. That was a question he did not want to answer.
Anne-Marie, we thank you so much for your time, for all of your reporting. Of course, that is Anne-Marie Hordern in Washington. Now, as we've been talking about, Wall Street strategists continue to cut their S&P 500 targets. We've seen Oppenheimer, Barclays, Evercore, Goldman, JP Morgan all adjust targets in recent days on fears of an economic slowdown. And last week, I spoke to Tabak Capital CIO Boaz Weinstein about what he's thinking about when it comes to a possible recession.
I think about it in probabilistic terms. We talked about the probability of recession. There's also the severity, and the tails for how bad it can be are much fatter than in my prior experience when I was thinking about a slowing economy.
We are also seeing pushback on Trump's tariffs from the likes of Bill Ackman and Stan Druckenmiller. Ackman calling for a 90-day reprieve so the countries can negotiate and prepare, and the world can avoid a, quote, nuclear economic winter when fully implemented on Wednesday. Let's discuss with David Rosenberg, founder and president of Rosenberg Research, coming to us from up north. David, thanks for your time, first of all. It looks like futures aren't hitting quite as hard, but I guess the fundamental question behind all of this, are Trump's tariffs, you think, the end game? Does he want to hold them and use them to raise funds for the U.S. government? Or is this a negotiating tactic where he's hoping other countries will come to the table and lower their tariffs?
Well, the problem with every country, say, dropping their tariffs to zero is not going to solve the fundamental problem as far as the White House sees it, which is countries running bilateral trade surpluses against the United States. So this is far deeper than tariffs. They were called reciprocal tariffs, but they're not reciprocal at all when you look at the actual formula that was constructed against each individual country or region. I think the EU has a 1 to 2% tariff against the United States, they're getting hit with a de facto 20% punitive levy, and it's because the way that the numbers were calculated, which was the bilateral trade gap divided by exports,
Right.
which is an overt attempt to create a situation where these countries have to have their trade surpluses with the United States completely obliterated.
Well, David.
So I don't know how do you negotiate that? How do you negotiate with each country? Governments of those countries aren't the ones doing the exporting to the United States. It's actual businesses. What are they going to say to their businesses? Stop exporting to the United States so we can get rid of our trade surplus
Right.
with America? Like, so what are you negotiating basically?
Yeah.
So it's a bit of a ruse in that it's not about tariffs. It's not about, all these countries can take their tariffs to zero. And the bilateral trade gaps they have with the U.S. aren't going to go away. And that's a fundamental issue for the administration because Donald Trump has been talking about the evils of trade deficits, or in this case, surpluses other countries have. He views them as a subsidy.
Right.
So he wants them totally eliminated. So when I hear the words coming out of the White House, well, 50 countries want to sit down at the table to negotiate. Negotiate what? How do you're going to negotiate basically a total upheaval of the global trading order? I guess that's what these discussions would have to be about.
Right. So,
because,
David, we've reported how incredibly difficult it would be to eliminate trade deficits. But in your view, I mean, if it's not tariffs that this is about, if it's about trade deficits, where does that leave the market? Because if we're just chasing something, the administration is chasing something that might not materialize. And it seems that the Trump administration, as they've said repeatedly, are not concerned about what's going on with the market. What does that mean for investors?
I think that it means more of the same of what we've had over the course of the past couple of days. I don't think anything's going to zero, and you've had sentiment washed out dramatically. But keep in mind that despite the carnage, for example, in the stock market, we went into this thing with a 22 forward multiple. Now we're at 19. We're still above the long run average. So you have to see, I think, more valuation adjustment in the stock market. Of course, none of us know what the ultimate impact is going to be on the E. We still know that although there's been a tremendous pullback in the market in short order, it's still not a cheap market. And then, of course, nobody knows where the E is going to be. So we're left in this bog of uncertainty.
David,
what do you do in a bog? What do you do in a bog of uncertainty? You probably want to move into cash bonds and even probably golds, like all the classic safe havens for the time being.
Yeah, David, one question I have is you have people revising their forecasts lower for the S&P 500. You pointed out the uncertainty around earnings, but you also have economists now bringing down their forecasts. You have Goldman, for example, rising their recession probability to 45% and growth down to 0.5%. But this assumes, David, that the April 9th tariffs don't take effect in their entirety. Why are so many strategists, economists, investors not taking the president at face value anymore, despite how much we've seen an escalation?
Well, I'm not so sure that I saw that out of the various Wall Street economists that you've discussed. I think that they did factor in the tariff staying in place. What they didn't factor in is what sort of further retaliatory measures are going to take place, because what we're finding out about China is that they're not going to back down, and they hit back with a 34% equivalent levy on U.S. goods on Friday. So the problem is that you can try and do your best estimating what's already happened. I haven't seen anybody saying, well, we're not assuming what happened in the Rose Garden last week is not going to be in our forecast. I think that's in the forecast. What's not in the forecast is what happened in the 1930s, which was not just the initial shock from Smoot-Hawley, but the fact other countries retaliated, and we tripped into a global trade war. And that has all sorts of other monumental second-round impacts right back on the economy. So I think that's really right now what the big question marks are. We've seen China hit back. We haven't seen what the EU is going to do. And the EU can hit back big time, especially on services. And so those are really the big unknowns right now. The big to me, the big unknowns aren't, oh, well, these countries are going to sit down with the White House and start negotiating. Negotiating what? Everybody thought we had the negotiations heading into last week's reciprocal tariffs. So what are we going to negotiate, basically? That's not the issue. The issue is really how are other countries going to hit back? And we haven't seen that full brunt just yet.
David, you're going to stick with us. We'll ask you where the bottom is when we come back. I want to get a look at some of the stocks moving right now ahead of the opening bell. For that, we go to Bloomberg's Bailey Lipschultz. Bailey?
Matt, everything is down pretty much. So keeping an eye on big tech under pressure, Tesla, Nvidia, Apple, you name it, under notable selling pressure. One thing I want to call out, guys, just hitting my inbox from the Morgan Stanley Wealth Management Global Investment Committee. They're talking about taking at face value the Liberation Day tariffs. They say, quote, if we knew this was the end game, we would be aggressively selling equities and calling for a recession-induced bear market. So you're seeing a lot of investors getting out of what were some of the biggest winners. Obviously, when a key member of the Trump administration comes out saying this is a Mag 7, not a MAGA problem, we're seeing investors really dumping anything associated with risk, presumably hitting some of those big high flyers, obviously exposed to these tariffs, but also just the sense that if valuations are going to snap back ahead of an earnings season, you're going to get out of the areas that had really been a safe haven.
All right, Bailey Lipschultz, great roundup. Stay close. That is Bloomberg's Bailey Lipschultz. A quick check on futures here as we count down to the opening bell on what is shaping up to be a very rough day. The S&P 500 down 2.8% in the pre-market. If we have time, I would bring up the bond market right now. 10-year Treasury yields up 4 basis points. An interesting note from Neil Dutta saying that I think people are beginning to dump their bonds to raise cash. We'll explore next. This is Open Interest.
All right, shares of Tesla have plunged in the market route, trading now around $226, but well below the price on March 19th. The stock was $235 when Commerce Secretary Howard Lutnick predicted the stock would, quote, never be this cheap again. Joining us now to talk more about how that has actually happened is Bloomberg Technology co-host Caroline Hyde. So, Caroline, here we are, lower than a level Lutnick said couldn't happen.
And Tesla CEO Elon Musk himself had said, time to buy, not according to the markets. Now, we've got some perma bulls totally changing their opinion on Tesla now when it comes to the price target. Dan Ives still has this stock at an outperform, but he cuts it from $550, one of the highest on the street, to $315. We're down by almost more than 40%. And this is a mixture of repercussions and brand damage across the board. He's saying, look, Elon Musk needs to step up. He needs to bring his leadership. Not that Elon Musk particularly cares about what Wall Street analysts think a lot of the time. However, he really feels that the brand damage is being accelerated here. You could lose about 10% of future buyers, he thinks, at a conservative level. He's worried about China going more for their domestic players, for the NEOs, for the BYDs, rather than Teslas in particular. So he's really got a lot of anxiety around Tesla. But he calls it more broadly Armageddon. Economic Armageddon is what the tariffs are bringing us. That's why he also slashes his price target for Apple. He's still an outperform on Apple, but Apple being cut by more than 20%. And he's seeing that they are in the eye of the storm when it comes to their supply chain. And I think what we have to bring up is a tweet that he puts out there more broadly saying, we are setting US technology back by a decade.
Right.
Who wins? China wins.
There you have it, Bloomberg's Caroline Hyde. I know you have a big show on B-Tech coming up. That was Caroline Hyde reporting on, of course, that even bulls can change their stripes, Sonali. Just to reiterate that, Dan Ives writing a blistering note over the weekend saying that this Trump tariff Armageddon setting the tech world back, specifically the U.S. tech industry, a decade.
A decade. It's just incredible, to your point, because of what a bull he has been. But many people now capitulating. And we are back now with Rosenberg Research founder and president David Rosenberg. David, I want to point to your note this morning where you title it, Is the Market Oversold? You say yes. Is the bottom in? Likely not. So where's the bottom? How do you figure out how low, how bad things could get from here?
Well, you know, I spent the weekend fielding questions from clients about picking the bottom, to which my reply was, I'll leave the bottom picking to the proctologists because I think they do it better than the rest of us. You know, the sentiment is clearly washed out. And, you know, when the VIX breaks above 40, and we went back in the history books, and if you have a 12-month view, the market's up 96 96% of the time historically 12 months later. So the message was that we have a nice opportunity here. If you're willing to adopt a 12-month view, everybody tells me I'm a long-term investor, I'm a long-term investor, I'm a long-term investor, yet everybody looks at their portfolio like every 20 minutes. So the question is, and I think the president maybe put it best when he said, we're going to have to put up with some near-term disturbance or pain for the cause of the greater good, whatever that's going to turn out to be. But I think that you do have a lot of measures washed out. I mean, where in some cases, you got some critical sectors of the market, transports, consumer discretionary, the banks, all in bear market mode in the span of a week. Like what normally you take 6 months to do, we've done in this wild elevator ride just in the matter of the past few days.
Well,
what I'm saying is
let me
that
just jump in here and ask, because I think so many people in this market aren't used to default being anything but rise, and we could get in a situation where even with a rally, you want to sell those because the market will continue to go down, 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 like 2000, 2001, 2002. Is that what you're expecting here?
No, I think that, trying to pick the bottom in this bog of uncertainty is next to impossible. What I am saying is that if you're going to ask me in a year's time, looking at the indicators that I have at my disposal, I think the market will be up a year from now. It's like we're talking in in January, February of 2009 when we were sinking into the abyss and the banks were getting priced for zero. I never want to touch equities again. And yet, the VIX provided a tremendous buying opportunity signal if you had a 12-month view. If you bought the stock market in January, you had to ride out another 20% decline to the March 09 lows. But if you had a 12-month view, you made money. The question is, what is your tolerance for pain near term? Because nobody can actually pick the bottom. And are you willing to take on a 12-month view and be patient? So I think very suddenly you've had, a lot of appeal through the turbulence come into the market. But again, it depends on your time horizon. Do I think that we've hit bottom just yet? No. And I wouldn't tell anybody right now to jump into the market. But if you're underweight stocks and you didn't participate in the bubble and you're sitting with liquidity, you're getting a bit of an opportunity here. I would be tempted to sort of scale in gingerly. I would not jump in with both feet. And that's more of a message for people that have the liquidity and that didn't participate in the bubble and who weren't hurt by all this. There are people out there like me that weren't drinking the Kool-Aid at the highs. Ergo, I got the liquidity and the cash in place to look at this and to start picking my spots. And let's face it, the market has cheapened up a lot. We basically, you got these economists saying, well, 35% recession, 45%. I don't even know how they come up with a percent recession. You've got sectors in the market right now. And I would say that the credit market and the stock market have basically crossed the halfway point in pricing in a full-fledged recession. A lot of work's been done, maybe not enough. But then you got some sectors that are already in an official bear market.
Right.
And those are the ones that you might want to, start paying attention to and get your pencils and paper out, because I think we're building up. And if this continues in the next week, I'll tell you this much. If this continues in the next week, I'll probably turn very bullish on a 12-month view.
Well,
because the markets have a tendency to overshoot in both directions. We certainly did it at the highs, and we're going to do it at the lows. I'm not going to say we're there yet, but I think we're in a week's time or 2 weeks' time, we could be there.
Great.
Given how fast things are moving.
Great message from you, David. Really fascinating stuff to hear. Potential bullishness from such a world-famous bear. David Rosenberg there of Rosenberg Research, thank you for your time. Less than 12 minutes to go until the opening bell. We begin trading today with Robinhood's Stephanie Guild. Find out what the retail traders are doing. This is Open Interest on Bloomberg TV.
Well, strategists across Wall Street are slashing their S&P 500 price targets. JP Morgan's new year-end forecast has been revised down by 1,300 points. It now stands at 5,200 from 6,500 previously. The bank's bear case scenario is 4,000. Let's discuss this all with Stephanie Guild. She is president of Robinhood Asset Management and senior director of investment strategy for Robinhood Financial. So it's not just JP Morgan. You've also seen Evercore, Goldman, SocGen, and just in the past hour, Bank of America reduced their price targets. Obviously, there's a lot of pessimism right now. Are you feeling that as well?
Yeah, absolutely. I was doing all the math yesterday. The best number I can come to right now is like 5,400 on the S&P. I think there's a case you could easily make for 4,800. If you're looking at earnings growth expectations, like even though the S&P now is valued at 18 times, that's earnings estimates haven't changed from a bottom-up perspective. They're still 11.5%. So really, if you assume that, every 1% change in GDP equals 5% change in earnings growth. There's an estimate from the Yale Budget Lab that these tariffs are going to cost about 2% in GDP. That means 10%. That means very little earnings growth. And I think you could see 4,800 on the S&P. That's a little bit below where we are.
Wow. Really quickly here, because we've got to go to break in just about a minute. But, where does the upside start to come in? You're seeing people start to sell bonds, right, to start to potentially raise cash. Is there a lot more pain under the surface? When does this become disorderly?
I think the bond sell actually, to me, is just changing your duration because rates have come down the long end so much, and they're taking profits there. But I think you just got to squash all the hope in the market. I still think there's hope that this is going to end sooner than it really will.
Bill Ackman says maybe they'll just fire Lutnick and be done with it. It
doesn't look like just him.
Doesn't look like that's likely. Stephanie Guild is staying with us. We have futures that are obviously down now more than 3% as we head in to the open. This is Open Interest. All right, we are moments away from the start of trading, and futures that were down yesterday 5% got a little bit better into the morning. We were looking at 2.5% drops, which is like the new up, and now we're back down again, just about 3 1/3% on S&P futures. NASDAQ futures down 3.5%. We're looking at drops of basically 13% over the last 3 days, including these futures, which makes it the third worst event post-World War II for stocks. COVID was worse, and the great financial crisis was worse, but otherwise we didn't see a 3-day drop this bad in 1987. Here you see the New York Stock Exchange. You're going to see travelers there, and the stock has done killer over the last 5 years, up 170%, well outperforming the S&P 500. But even travelers on Friday was down 8%. Dollar Tree ringing the bell to celebrate their 30-year anniversary. This stock at the NASDAQ is off about 10%, 11% this year to date. But over the last 12 months, they've lost half of their value. So bad for them as well. Katie, in terms of the stocks to watch, what are the individual movers that you're focused on?
Well, I have to go right to Tesla right now because it's leading the Magnificent Seven losses this morning. That's after Dan Ives of Wedbush cut his price target by 43%, following brand damage from Elon Musk's work with Doge. Shares currently down about 7%. Sonali, certainly a sign of the times to see Dan Ives changing his tune.
Yeah, speaking of Dan Ives, he also lowered his target for Apple, which produces roughly 90% of iPhones in China. Apple is down another 6.5% after the brutal 2 days already. You're seeing, Matt, a 3-day decline looking like more like 20% or more for Apple.
All right, finally a check on NVIDIA, which just got cut to hold at HSBC and is now down more than 30% on the year. So we've lost basically a third of NVIDIA's value in 2025. S&P 500 on pace to enter a bear market at the close. Robinhood Senior Director of Investment Strategy Stephanie Guild joins us, or still with us, I should say. And how was your weekend? Was it? Did you have friends and family messaging how quick can I get out of this? Do I need to sell? Should I dump everything?
I did. I definitely did. And people were asking me about what do I do with my kids' 529s? What should I do about my 401ks? It really depends on where you are in your life. But that's why you want to do things in your 529s like in age-based, right? Like hopefully it's reduced risk by the time the kid gets to college.
Yeah.
But I definitely like, I don't know if you're fully at the capitulation point, even though I am getting those text messages, because you've got put-call ratio that's still a little bit lower than where peak levels can be. You've got VIX at above 48 last time I looked at it. It can be a bit higher. So, I think look, we just came from the unprecedented, non-recessionary, non-wartime deficit spending.
Right.
Like the most we've ever seen. And now we've swung to austerity. And, it's kind of like not getting enough sleep and eating, too much junk food. Like both are bad for you in the long run, but one at least is like, French fries at least taste good while you're doing it. So I just think we're like in an environment where there's still a little too much hope that this could end.
Right. Well, the president said it himself this past weekend that, it's not pleasant to take medicine. That's how he views what's going on in these financial markets, with the S&P 500 set to close in a bear market if we stay at these levels. But I want to talk about what's going on amid, or rather on the Robinhood platform. You have a really unique view into what the retail trader is doing. We've been tracking the ETF flows and other measures which show that there's a lot of dip buying going on. Are you seeing that on the Robinhood platform?
We have for the last week or so seeing dip buying. Our customers have been selective. So where we have seen, there's been a favorite still towards Tesla and Nvidia. And where you have seen some trimming has been more in Apple and Baba. I think things are just a little bit more consumer oriented versus, Tesla's consumer oriented, but.
Well, speaking of consumer-oriented, I think one thing that's hard for people to gauge, you mentioned that stat, that Budget Lab stat over at Yale, 3,800 per household likely to be wiped out on the heels of tariffs annually. How much pain will the consumer start to feel as they go to the grocery store, as they go to their retailers?
I mean, it's going to take time, right? Because you had probably a rush of goods that have been coming in, and that has been affecting, it has made it look like we have greater imports than exports than normal. And so you probably have some inventory here to get through for a little while, but it's going to start feeling, it's a tax on every single person in this country. And I think that's what everyone needs to understand, is that this is absolutely going to slow down the economy.
I just want to show, on the Bloomberg terminal, if you type WSL politics, we've put up, Michael McDonough and his team have put up a chart of all the 3-day drops that have been the worst. And it actually goes the worst on the bottom up to the top. So I misspoke at the top of the show. 1987 was even worse than what we're looking at right now. Black Monday, and that 3-day drop. Also, the great financial crisis had a slightly worse drop. But this is worse in terms of 3-day drops than COVID. So it's pretty serious. Does sometimes selling beget selling? Do you think this turns into a self-fulfilling prophecy?
I mean, that's exactly what behavioral finance says, right? Like you hear someone say sell, and then it turns into, until you get to some point where you just say, it feels bad enough that you hear people starting to say, just buy it and hold your nose. I don't know if we're there yet, but I definitely think it leads to that. I'd say the difference between those times and this time is similar to COVID. It's kind of a man-made disaster, but different than those two times is that the Fed could step in, and there is no Fed to fight this time. They are stuck between a rock and a hard place. They have to care about inflation just as much as growth. And growth hasn't, they could be late if it ends up being growth.
Right. Well, that's where I wanted to go, because, you've seen that pricing for, I think, 4 or 5 Fed rate cuts at one point this year. Yeah. There was even a little bit of pricing for an emergency out-of-meeting Fed rate cut. But, I mean, to bring it back to that, what would that even do, especially if the ultimate fear here is that we're going to enter a inflationary period? Why would you cut rates into that?
I think, Powell's been pretty clear that he's not ready to do anything yet. He's going to watch it, and he does admit that this could lead to slower growth, but also admits that this could lead to higher inflation. And so the scales are exactly balanced, in my opinion, for him, and that he has to wait to see what tips it. And growth has to be deep enough that inflation, he'll tolerate higher inflation.
Just to give a sense of how negative sentiment is today, I just want to show the components of the S&P 500, because you only have about 5 stocks in the green on the day. So it's brutal. out there. Almost everything being sold off today, 3 days later. So if this is the case, what would be the positive catalyst at this point? What is the moment that this market is waiting for, given that recession odds are baked in regardless? Goldman's recession odds counts on tariffs being lighter than what Trump has said you'd see on April 9th.
Yeah,
it's incredible.
I think the market's starting to believe what has been said from this administration, and just trying to defend themselves now. Perhaps it always happens a little bit late. I think, we've been starting managing money actually for our customers, and last week on Monday we actually started taking
what a
on
week
more
to start.
cash. Yeah, it's been an interesting time, but I think this is when you learn the most, and this is when you can kind of show your worth the most. So we've increased cash across our positions as of last week, but I think what you're starting to see is that people are just starting to realize and understand what this all means. I think if you do actually start to see some negotiations, you could start to see at least a bottoming. I don't even know if you just need to see a calmer, a bottoming before you start to say, okay, at least we maybe reached the end.
Stephanie, we're so glad to have you today. Of course, that is Stephanie Guild of Robinhood. Now we're going to go to the big money, also the fast money, hedge funds, because they are being hit with some of their largest margin calls since the COVID pandemic. Bloomberg's Michael Ball reported on this, joins us now. You actually had a little bit of an optimistic note in this report as well. This idea that maybe the worst of the margin calls have been seen. When I talk to my sources across the street, they say they haven't seen disorderly unwinding yet. What would cause this to become disorderly?
Well, it's been a little disorderly Friday and again overnight. Generally, when you see the VIX getting as high as it has been, it means people are really reaching for protection, or they're outright getting out of long positions. That's kind of what's been going on. They've been getting the tap on the shoulder, and the cost of their margins has gone way up.
So how do we know when these hedge funds are at the end of their margin calls? How do you know if the biggest ones have passed and that we can start building a bottom?
Yeah, so we'll get that data delayed, but generally going into this, there was already a de-risking occurring as kind of growth outlook was weakening. So this actually hasn't been as bad as it could have been. But since the tariffs were higher than expected, we did have that sort of capitulation in the last couple sessions.
And Michael, one of the reasons we wanted to have you on was because you have this really interesting angle to look at what's going on in the options market. And when you take a peek at what the derivatives world looks like right now, how are folks actually positioned? You were talking a bit about margin calls, but even beyond the big hedge funds, have we seen the washout yet?
Because this has happened so quickly, we actually have a lot of open ground to cover now. Now, 2 weeks ago, as you remember, we were often talking about the JPM collar or this 5,500 level. But since we've crashed sort of below that, no one's been able to reset positions. So there isn't a lot of support. The 5,000 level right now in the SPX is where a lot of hedging needs to occur, and that has some gravity, which means that dealers will be buying and selling into that position, which creates support.
All right, Michael Ball of the Markets Live blog, thank you very much. Great reporting. Let's take a quick check on these markets right now. We're 10 minutes into the session, and the S&P 500 briefly reaching session lows below that 4% drawdown level. Of course, we are in bear market territory if we end today's session around these levels. Volume off the charts right now when it comes to the trade. We'll walk through it next. And also coming up, Jamie Dimon says that tariff policies need to be resolved quickly as banks extend their slide. That's next. This is Open Interest. All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, as we've been discussing, Dan Ives, he's one of Wall Street's most bullish Tesla analysts, slashing his price target for the stock by 43%, citing a brand crisis that was created by Elon Musk and President Trump's trade policies. Next up, we have Starbucks getting downgraded at Baird as it takes a more conservative stance on the entire restaurant industry in light of Trump's tariffs. And finally, we have Morgan Stanley downgrading the entire banking sector, saying that President Trump's tariff policy increases the risk of recession. Goldman Sachs is just one of the examples of those downgrades, Sonali.
And meanwhile, JP Morgan CEO Jamie Dimon is speaking out on the market meltdown. Dimon says tariff policy issues need to be resolved quickly, and he warns against a potentially disastrous fragmentation of America's long-term economic alliances. We're joined now by Bloomberg's chief Wall Street correspondent, Sridhar Natarajan. He talks about this geopolitics, the tariff threats, all adding to mounting pressures. You have Jamie Dimon himself making that potential recession call. JP Morgan's own earnings out this week. How much is Wall Street experiencing the pain that Dimon is talking about?
I think they're experiencing the pain not so much as what's happened in the last few days, but they're really worried about what lies ahead of them in the next few quarters. That is the big issue here. And you can be rest assured, like, everyone's looking forward to Jamie Dimon's annual letter. He probably wrote most of these 60 pages well ahead of the tariff announcement, but a lot of changes were made in the last couple of days, and that's evident in his tariff commentary. By Jamie Dimon's standards, I will say this was fairly muted. Still, he does make the important point that the longer that this lasts, the negative reaction and the negative effects will accumulate. You will have a cumulative effect, and that will affect the broader economy. That will affect the country broadly, and most certainly the bank he runs and the rest of the banking sector.
I just want to point out we're looking now at a 4 1/3% drop in the S&P 500. So the Dow Jones Industrial Average is down 1,540 points. This market decline continues. At what point does Jamie Dimon come out and, show some real spine, re the Trump administration? Because you're right, his message was fairly measured, and he's not known for mincing his words.
Look, this is not the first act of, if you want to call it, craziness that we've seen in this administration in the last 2 months, right? And if you're talking about corporate leaders willing to come out and say publicly what they've been telling us privately, what they've been telling each other privately, you're not really seeing any signs of that happening. Whether you're talking about a tariff issue and you're saying when money starts to bite, you certainly expect a lot of these people to be more forthright. You've certainly seen that, especially with someone like a Bill Ackman. Look at his tweets going into the weekend and look at his tweets starting 6 p.m. last night. Big change in tone. And perhaps that reflection will be seen more broadly. And as you see more and more people willing to take it forward, willing to amp up their rhetoric on this, more people will come forward. But to realistically expect these corporate leaders to go out there and say they wholeheartedly disagree with this administration's moves and to express that in such a clear and forthright manner is perhaps still a bit of a reach.
Yeah, and we have Bill Ackman's tweet, his post on X starting that last night. You mentioned 6 p.m. That's, of course, when futures opened, and we saw that big drawdown. So he also called for sort of a pause heading into the April 9th tariff implementation. I don't know if that will happen, but it's interesting, Shri. I mean, you just think about where we were heading into inauguration. Of course, we had Bessent set up as Treasury Secretary, and there was this idea that, he was going to be the adult in the room. He had a lot of Wall Street connections. I imagine a lot of the sort of folks that you speak to, those C-suites type people and the bankers that you speak to are trying to get on the phone with Scott Bessent and figure out what's going on.
They're certainly trying. If they can't get on the phone with him, they've certainly been texting him quite a bit. Not clear if it's just one-way channel. It does feel like that. It doesn't seem like Bessent is necessarily engaging with them. But part of that could also be, as some of our reporting shows over the weekend, that Bessent is not really one of the critical players as we navigate this period right now. As we navigate the tariff policy, it doesn't seem like he's a principal in the room. He's been playing a bit of a second fiddle, and that was evident in some of his comments to Marie last week, right after Trump's initial tariff announcements.
All right, Shri, great to have you on for our Wall Street beat. Shri Natarajan oversees the banks for us here, oversees Wall Street for us here. Coming up, billions of dollars of deals have been put on pause due to Donald Trump's trade war, and don't even think about going public in these markets. We'll take a look at that next. This is Open Interest. This is Bloomberg Open Interest. Let's get a check on what's going on in stocks. Just about 20 minutes into the session, we're down about 3%, a little bit more on the S&P 500 after back-to-back drops of 5% plus last week. So we're looking at the worst three-day drop, the third worst three-day drop since World War II, after 1987 and the Great Financial Crisis. This is it, worse than COVID. Take a look at some of the stocks that are falling. Nvidia down 4.25%. Obviously a huge heavyweight, as is Apple, down 4.6%. These are dragging down the S&P. Tesla falling another 7% right now, trading at $223 a share. And then you can see Alphabet, Google down 2%. So not doing so bad by today's standards. Neither is Microsoft. Palantir down 5 1/3. Katie?
Well, amid the meltdown that we've seen over the past week, billions of dollars worth of deals and IPOs are now on hold as the Trump trade war upends the global economy. StubHub, Klarna, eToro, Mountain, and Ategrity all pressing pause on upcoming plans to go public. Let's discuss now with Bloomberg's Todd Gillespie. And Todd, I guess it would be more amazing if you did have some of these candidates still proceeding and saying, I want to go public right now in this market.
Yeah, absolutely, Katie. I mean, right, some of these are kind of obvious right now. These are companies that, have long, touted their IPO plans. People are very much expecting them to go public at some point. But right now, if they can choose to wait, why wouldn't they? No investors right now are chomping at the bit to, to dive into a new IPO with all the risks that it entails. But, you have to ask as well, at what point do we see these kind of return to market? At what point will these roadshows get back on the road again? And who knows when that normalization will continue?
And some of these companies that we're talking about have been long-awaited IPOs. Klarna, for years, we're hearing from sources that these were companies that were in slightly better shape anyways. What do you make of the companies that are not in as good shape, that maybe have to take massive down rounds, that maybe not able to see the light of the capital markets for months, if not years again?
Yeah. Right, exactly, Sonali. And you've got a lot of startup. You want to think about the startup culture in this country. You want to think about the venture capital space right now. You want to think about the high risk investors who are looking to allocate capital into all sorts of companies, biotech, all these companies that are already having, swaths of uncertainty from the policy environment. Now again, for instance, in the healthcare space because of RFK Jr. or whatever, and now they're getting added dollops of uncertainty from, the funding environment, from the public markets as well. So yeah, it's really kind of scary for some of these folks now.
It's pretty clear that you don't want to sell in this market, whether it's an IPO or, to an industrial buyer. I wonder, though, about overseas M&A. I mean, I've heard from private equity fund managers that they're trying to buy companies in France, they're trying to buy companies in Italy, and it's no-go because the administrations there just don't want to have it.
Yeah. I mean, certainly that's true. I mean, you don't know which countries are going to come and get some kind of negotiation down from Trump, kind of get their tariff rate cut. I mean, one of the things that I was actually looking at this morning was the share prices of the boutique investment banks in New York. You talk about cross-border M&A, you talk about Europe. I looked at Lazard. You look at Lazard's share price, it's lower today than this time last year. So all of that confidence heading into the election, all of that confidence of the election of Donald Trump, all of that, that boom time that you saw for boutiques going into 2025, that's been erased.
Yeah, feels like a long time ago, doesn't it?
Oh, yeah.
All right, Todd, great reporting as always. That is Bloomberg's Todd Gillespie. We're talking about, of course, these IPOs being delayed. You take a look at CoreWeave. It went public pretty much, I think, on the last day that you could have in this current market. It's still higher since its IPO. It's trading at $44 a share right now,
it's
so
incredible.
Good on them.
Even with the sell-off we've seen in Newsmax, even they are also still above the IPO price. And I've got to say, a lot of the reason you saw Morgan Stanley slash their estimates for the banks, which start reporting on Friday, as we've been talking about, was the lack of those capital markets fees.
All right, let's take a look at what's ahead this week. Tomorrow, we're going to get a read on the state of small businesses from the NFIB. On Wednesday, we get Fed minutes from the March meeting. We'll see if there's milquetoast, as Jerome Powell was on Friday. Plus, higher U.S. tariffs take effect on imports from more than 50 countries and territories. You may have heard of those so-called reciprocal tariffs. On Thursday, we get CPI and jobless claims data. Trump has already told us there's no inflation, so we might as well not even look at that number. And we round out the week with U.S. bank earnings on Friday. Sonali's Super Bowl, really looking forward to that. Coming up in the next hour, the CEO of Empower, Ed Murphy, talks about the state of your 401k. Then we have Bill Dudley on the possibility of a Fed intervention. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, the market meltdown shows no signs of letting up. The S&P 500 is heading for its first bear market since the pandemic.
The Trump administration dismisses investor fears of inflation and recession as traders boost their bets for Fed cuts this year. Former New York Fed President Bill Dudley joins Open Interest.
Plus, how the market sell-off is hitting Main Street. We'll speak with the CEO of the second largest retirement services provider in the U.S., Empower's Ed Murphy. All that and more coming up, but a quick check on these markets right now. The S&P 500 paring its losses, now down just 1.7%, which is still pretty amazing, but we were down nearly 4.5% at one point this morning in the cash trade. Similar story if you take a look at the NASDAQ 100. I want to focus on the 10-year for a beat here, though. The 10-year Treasury yield higher by 7 basis points. Neil Dutta writing that perhaps people are selling bonds to raise cash. That would certainly be a bad sign, Matt Miller. You do have the front end benefiting a little bit right now, or at least unchanged on the 2-year Treasury yield, but still a worrisome signal there.
If you listen to Neil, Stephanie Guild told us people are just taking profits after having a killer run last week, which also makes sense. Let's ask Matt Maley all of these questions. He joins us now, Miller Tabak, chief market strategist. And Matt, you know, at the top of the show, we were talking to David Rosenberg, who is one of the great bears of our time, right? And he was saying you might want a dollar cost average in after this kind of drop. Do you agree it may be a buying opportunity?
Well, yeah, Matt, I think that, one of the things at the beginning of the year, I was looking for a 15 to 20% correction. Well, now it's worse than that. And, it's the situation where, I say take some, raise cash, get defensive, was something I was saying, again, for the entire first quarter. But now we want to switch that a little bit. And the thing is, the dollar cost averaging is a good way to play because we don't know what the ultimate bottom is going to be. We've certainly had forced selling going on the last couple of days. We could see another bout of that at some point in the future. So if you go out, and this is something we talked about at Miller Tabak back in the summer of 2022, you look at some of the names that you like that are cheap. Back then we looked at Meta, and that may be another good play right now. And you buy a little bit each month or every couple of weeks over the next 6 months or over the next of the year. Your average price is going to look really good a couple of years from now, just like it did, after the summer of 2022. So that'd be a good play, especially for the ones that have finally gotten somewhat cheap here.
Right, yeah, and you take a look at Amazon shares right now, briefly erasing gains, actually turning positive at one point. So you are seeing a little bit of a bounce back, and it seems like it's big tech that's leading that. But Matt, I actually want to go back to the bond market a little bit and what signal we should take from the fact that you have 10-year Treasury yields up 7 basis points right now. If you take a look further out the curve, the 30-year higher by 12 basis points. We have the Steph Guild view that maybe people are just taking profit here. Maybe they're rotating into shorter duration. But if you really wanted to get scared, you could say that maybe people are selling their bonds to buy cash.
That could be the case, and I think we saw that like last week in gold, where gold was really getting hammered pretty good. You think that would be a good flight to safety trade, and it didn't work out as well, although it's obviously worked very, very, very well this year. But the thing is, we do have to remember is that when you get this forced selling, and we do know that there's some leverage traders, especially on the institutional side, some of these hedge funds and stuff, lost a lot of money, okay, and they're getting that forced selling that you talked about. The thing is, though, when that forced selling subsides, you get a big move up in the stock market, and you'll see a big move down. I say big move, but down in bond prices, which means that bond yields will go back up. So I guess my point is, when we get these kind of flush moves, these washout moves, you got to be careful about reading too much into it. I think I'm worried about what's going on with the economy and what the bond market's been signaling over the last couple of weeks about what's going on with the economy. And therefore, the stock market's going to have a tough time bouncing back in a major way like it has many times in the past. But I do think that I think people that get too nervous here and panic are going to be sorry if they do.
Matt, speaking of the economy, I'm looking at the yield curve. I'm looking at the 210 curve, but you can look further out, and you have not really seen much of a correction there. The reason I bring this up is Boaz Weinstein over the weekend of Saba Capital made the point to me that perhaps he's more worried about year 2 than year 5. He expects a flattening of yield curves, and of course that would impact another trade that is being very, very hard hit, the banks. Do you see a flattening, particularly if you think a recession is imminent?
Well, it's kind of funny because one of the weird things that takes place is when the yield curve goes inverted, it really doesn't become a problem until it actually goes back into positive territory, which has happened in the last few months. But to answer your question directly, yes, I do worry about that. The big thing is what does this mean for the Fed? What happens with the banks here is so important for what the Fed does. I'm sorry to say it, but the Fed doesn't care about the stock market all that much. If the stock market goes down and it doesn't have an impact on the financial system, they'll let it play out. That's certainly what they did during when the dot-com bubble burst, and that's what they did in 2022. If you start to see stress on the banks, in other areas like that, they will step in. So in an odd way, that's something that we could actually look at getting something much more out of the Fed, because simply cutting interest rates is not the Fed put. The Fed put is when they start adding liquidity to the system through QE or some other programs like that. I don't really see that coming right now, but that's something to keep an eye on.
Matt, we're going to talk to Bill Dudley in a little bit, formerly of New York Fed, and he has a column on the Terminal today saying stagflation is really your best case scenario now as the weighted average cost of tariffs rises to 25% from 3%. He says inflation is likely to go to 5%. What's your take on the economy further out in 2025 and 2026?
Well, that's what I mean. Obviously, the odds of recession are growing significantly. I mean, the problem is the economy was already slowing in a meaningful way before we realized that the tariff issue was going to be as aggressive as it was. Consumer was pulling back and seeing some real stress. We realized that the AI phenomenon wasn't going to produce the kind of earnings and broadness of earnings that people had thought. So that's a problem. It reminds me of the 1970s. Now, I don't think we're going to have anywhere near as much of the stagflation as we had back then, but that does make me worried that the stock market will come down and stay down and not get that big recovery we've seen every time. Therefore, it's going to be very, very important to be your stock picking is going to be much more important, and maybe playing some things where you're actually buying for yield, things that will pay you to wait for a while, and play it a little bit more defensively.
Yeah, head on a swivel in this market. Matt, it's great to speak with you. That is Matt Maley of Miller Tabak. Meanwhile, let's talk a little bit more about the Fed, because traders are increasing their expectations for further rate cuts this year. The market's actually briefly priced in 125 basis points of easing by year end. That would be equivalent to 5 quarter-point moves. Let's bring in now Bloomberg's Mike McKee. At one point, too, they were pricing in an emergency Fed cut, which was pretty amazing. But build on this conversation that we were just having with Matt Maley. He says that the Fed put isn't them cutting rates, it's them adding liquidity to the system. But does the Fed, how much concern is actually there at the FOMC policymaker level about what's going on in these markets?
Well, Matt's exactly correct. They don't care if the stock market goes down and you lose money as long as the markets are functioning, and they seem to be functioning very well. We've seen a deep decline over 3 days, but contained drop each day. We haven't seen the kind of thing that, I mean, certainly you saw in 1987. So it doesn't look like they're going to go anywhere. Now, we've got a lot of Fed speak this week, and a lot of them are board members, open market committee members who vote. So we could see some hints about things being talked about. Anita Kugler speaking today, and there is a board meeting, by the way, of the Board of Governors to talk about discount rate minutes. It's something they do every time. It's regularly scheduled, and some people on social media were thinking maybe there's an emergency meeting today, but that's tinfoil hat stuff. Then later in the week, you get Schmidt and Goolsbee.
Well, there is a meeting today, right?
There is a meeting, but not of the whole Open Market Committee, just of the Board of Governors.
But this has long been planned, is
long
your
been
point?
planned, yes.
Okay.
And so you do have more Fed people coming out this week. The question then is, why would they act? People on Wall Street think to forestall a recession, and that seems to be the bet with the cuts, is that people are betting on growth as opposed to inflation, because the Fed wants to lean against inflation. And we are seeing financial conditions tighten with the way the stock market's going, and we don't know who's swimming naked. The water's going out, but the Fed doesn't have good visibility, certainly, into non-bank areas and who may be having problems, although we haven't seen anybody blow up yet.
What about inflation? I mean, on one hand, you can understand why market participants think the Fed will step in the event of a recession. But if you do have inflation, Citadel Securities thinks almost 5%, right? You have some people with sky-high expectations.
So does Bill Dudley.
So does Bill Dudley, and so does, their range of expectations. TD Bank under 4%. 12% still. But if you have that kind of inflation, how are they going to cut it all?
Well, they're not if they're going to have that kind of inflation. And Michael Gapin from Morgan Stanley was on surveillance this morning saying exactly that. They've taken their Fed calls out because they don't think the Fed is going to be dealing with recession as much as they are going to be dealing with inflation. If there is a problem out there, Fed put-wise, you've got the discount window. Banks can borrow from that. And then the standing repo facility. Mr. Weinstein or people at Citadel could go there if they needed to raise cash. So the Fed's just going to stand by until they get some real data on what's happening and whether it's inflation that's a concern or growth or neither. For right now, they're on hold.
All right, Mike, thanks very much. We're going to be talking to you a lot about this economy, obviously, in the coming week. Bloomberg's Michael McKee. Let's get a look at some of the stocks moving at this hour. Tesla remains the biggest drag on the S&P 500. And although it's only down 3% right now.
Yeah, so, you're seeing a real bounce back.
That's a real recovery. Let's take a look at what's going on with Amazon right now, because I think it has actually flipped into the green, and indeed it is now up 2%. So you have some shares starting to turn positive. Sonali, you were looking at the S&P. No, the S&P index earlier, and we only had 3 gainers, right? Now we have 103 gainers.
Check that out. And in the Magnificent Seven, to your point, Amazon is the biggest gainer, but you do have 4 of the 7 components now in the green. So looking for silver lining.
Let's talk about one of them, NVIDIA. It was down pretty sharply, but now you can see it's higher by over 3%. That is your biggest points contributor to this upswing that we're seeing in the S&P 500, and it just turned positive. So here is the bounce back. We're watching it unfold in real time. The question is about whether this is sustainable and what volatility lies ahead.
Yeah, the S&P right now up 0.2%. So what a roller coaster ride this has been. We're starting to see the indexes turn positive. The Dow Jones Industrial Average is only off 200 points, which is like up.
Yeah.
In current terms. What a turnaround. We're going to continue to talk about this when we come back with the CEO of Empower. I checked my 401k this morning and I almost had a heart attack. I honestly didn't think I'd be able to do the show, but I'm starting to feel a little bit better now. Ed Murphy joins us next. This is Open Interest.
Let's get a check on these markets and the turnaround that is underway, because you have the S&P 500 up by 1.6%. Remember, at one point in the cash trade, it was down 4.5%. So a really violent reversal that we're seeing right now. The NASDAQ 100 leading these gains, this rebound, with big tech currently up about 2.5%. I just want to note that volume off the charts. Once again, the S&P 500's volume is 140% higher than its 30-day average. So just amazing there. And Matt Miller brought up the bond market in the break, and I want to go there because the 10-year Treasury yield, we're knocking on the door of 420, I believe you said.
It makes me feel so much more comfortable when we get to 420.
There you go, for many reasons, I'm sure. But it's interesting that, of course, it was the bond market that led this move. The bond market has been selling off all of this morning. You haven't seen that haven rush, and now the stock market is following.
I just want to point out also, yesterday when we were in full-on panic mode, and I know it wasn't disorderly, but you had NYMEX crude under $60 a barrel, which is a real problem for Texas.
Yeah.
It's a real problem for Oklahoma. It's a real problem for all of Trump's supporters in the Southwest. So to see crude climbing back up again, more than $1 to 63 right now is, I would say, helpful to his agenda.
Yeah, there you have it. So we'll continue to track that reversal. But let's broaden out the conversation, because prior to the last 10 minutes or so, the market sell-off really causing anxiety among retirees and everyone else. But specifically when it comes to retirees, according to Fed data, people 55 and older hold about 79% of equities in mutual funds among U.S. households. Let's discuss now with Ed Murphy. He is the CEO of Empower, which is the second largest retirement services provider in the United States. Great to have you here on set, Ed.
Thanks, Katie. Good to be here.
So I'll build off of what Matt was saying before we had headed to break last block, and that's that you have a lot of people, not to be glib, freaking out about what is going on with their retirement accounts, with their 401ks. And obviously, you've been in this business for a long time. You've seen market cycles and market corrections before. What message would you bring to the folks who actually are checking their 401ks and getting quite nervous here?
Yeah. It's a message of reassurance and staying the course. If I look at the last week, Thursday and Friday, we saw a 30% increase in the call volume coming into our call centers. But what we found was, for the most part, people were just seeking account balance information, maybe looking for advice, but trading activity was pretty de minimis. We didn't see much in the way of trading activity. I think what's happened is investors have learned to deal with these gyrations in the market, and they understand that these investments are longer-term investments. And the industry, I think the media has done a really good job of encouraging people to stay the course. And so that's what we're seeing right now.
Yeah, for sure. If you have a longer-term outlook, I'm not going to retire for probably 15 years.
Really?
I still, because of the ease of using your app, I'm still looking at it a lot when we have volatile days like this. Speaking of volatility, take a look at the indexes that were NASDAQ 100 up
Unbelievable.
more than 4% right now. We had the S&P continuing to climb now more than 3%. Do you see, again, because of how easy you've made it for people to interact with their 401ks, more activity? Like, are more people going in and saying, I want to change the balance, the mix of my portfolio, and actually doing it?
Not so much the balance, Matt, or changing the balances or repositioning, restructuring the portfolio per se. What we see is high levels of engagement. So we track usage of the app, we track usage of the website. We have 19 million customers, so we're monitoring that activity all the time. I think people really understand the benefit of dollar cost averaging. Most of our savers are saving through payroll deduction. So every 2 weeks or every week, they're saving money in their retirement accounts. The one thing I would note, if you look at our wealth management business, we saw an increase of 200% in trading activity on Thursday and Friday. 75% of those trades were purchases. So the retail investor has not capitulated. The retail investor has stayed the course. And in some instances, I would suggest that they're leading this rebound right now. There's $7 trillion in money markets, the highest amount in the history that we've had in money market accounts. So I think there's a lot of cash on the sidelines that looking to take advantage of opportunities in the market.
Just trying to think long term for a second here, for even longer, because there is so much volatility. And even with today's rise, as we're seeing, at least for the moment, you are still seeing the S&P 500 wiping out roughly half of last year's gains. So yes, maybe Matt might retire 15 years from now, but what about the people who are retiring right now? What about the people who are living off that retirement income? How are they feeling? What are they doing?
Well, I think that's definitely a challenge. What you find, though, particularly for retirement investors, most of them are in a diversified portfolio. So when you look at an index like the S&P down in bear market territory, typically those in retirement accounts are not suffering losses that are consistent with the S&P 500 because of the diversification. 70% of the assets are in target date funds, multi-asset class type funds. So you don't necessarily see that level exposure. That being said, I think the concern that you raise is a real one. If you're in retirement or you're nearing retirement and you see this kind of a decline, it can be a bit concerning. And so, obviously we encourage people to have emergency savings account, to have at least 2 years of expenses set aside in the event that these types of situations occur.
And, if we hadn't seen this big meltdown that we've seen over the past week, we'd probably have led this interview with the conversation around putting private assets in 401ks. But I do want to talk about that because one of the benefits of private markets is that, you don't have intraday prices unless, of course, you're in an ETF. But that volatility, that day-to-day volatility, you're kind of insulated from it, at least on a psychological level. So take us into that conversation because it's been floated as a real possibility under this new SEC that you could see privates work their way into the retirement system.
I think we will. If you look at the markets, the structure of the markets have changed so much. We have 40% less publicly traded companies today than we had 20 years ago. You also have 87 to 90% of the companies in the United States with revenues over 100 million are private. So because we have this structural change, we have 125 million investors today that don't have access to the private markets inside the defined contribution context. And so Empower's I've been pretty outspoken about this. I think it's the right thing to do longer term. We could do it in a way that's safe. We could do it in a way that's cost effective. If you think about it, it's typically long-term money, long-term savings. And so you have the liquidity premium associated with private equity, private markets. And so I think the Trump administration and the legislature, I think, will work together, and we'll see the opportunity perhaps for a safe harbor for sponsors so they can feel more comfortable in offering these plans.
Ed, at the very least, I should be able to use ETFs in my 401k, shouldn't I? I mean, that lowers costs substantially.
Yes, Matt, but what I would say is a lot of sponsors haven't necessarily embraced the idea of ETFs because of the frequency of trading, and they want to obviously discourage that. If you look at index funds and some of the other low-price vehicles that are offered inside the contribution plans, the price compression that's occurred over the last several years has been very favorable to investors. And so I would submit that with index funds and even with active funds, we've seen a significant decline in the expense ratios.
Ed, one thing I'm wondering is, are you seeing any kind of scary behavior in this market? For example, people taking out loans from their 401k to get through this period.
How does that graph look over the last year, say?
It's definitely increased, and I think there's a corollary to what you're seeing in the U.S. economy with deferred payments on auto loans, deferred payments on mortgages. So we've definitely seen an increase in hardship withdrawals, not material, but certainly an increase, maybe a 15 to 20% increase over what the historical norm is. And I think part of that was fueled by the inflation that people were experiencing, particularly last year and the year before. So that's something we monitor very carefully. It's an important consideration.
Ed, we thank you so much for joining us here on set today. Of course, a choppy market. People are trying to look to the long term. That is Empower CEO Ed Murphy. Katie, I know we're getting a check on these markets here, but right before that, I just want to read some of the things that have been coming out of Washington over the last hour that might be impacting some of the sentiment, including from ABC, where businesses, conservative lawyers, they're planning a legal challenge to Trump's tariffs, according to ABC, that could come as soon as this Friday. So businesses pushing back. You also have from the White House itself, President Donald Trump saying he spoke to Japanese Prime Minister Shigeru Ishiba on Monday, looking for tough but fair parameters being set. Of course, we're now seeing the S&P 500 lower once again. Of course, some people getting into the dip buying, but it was short-lived, wasn't it?
Yeah, absolutely. I mean, you're seeing the volatility really in force intraday, and you can see that again. The S&P 500 now down pretty meaningfully, down 1%. We were higher by 1.5%. Down once again. Let's take a look under the hood and see what is actually driving that. Tech has been sort of the epicenter of volatility when it comes to the benchmark level. If you take a look at the Magnificent Seven, you can see there that Amazon still holding on to its rebound, up about 1%, but gains slipping, as you can see there. Tesla, once again, leading us to the downside, and you can see Meta, too. It had been rebounding. It's still positive. The color is still green. But again, these are pretty feeble gains. Let's take a look at the chip sector as well. Specifically, NVIDIA, you can see down about 0.6%. You do have some spots where you can pick and choose and find some green on the screen, but overall pretty ugly. And Intel down nearly 3%. And then let's end on these banks. Of course, bank earnings begin in earnest on Friday towards the end of the week. JP Morgan off a little bit right now. We heard from Jamie Dimon in his annual letter earlier this morning. Citigroup down 0.7%. Bank of America actually higher right now. Banks had been among some of the hardest hit, but at least on the balance of today, it looks like they're getting a little bit of relief.
All right, we're seeing U.S. Steel also rising today on some of those Trump headlines, right?
Yeah, I want to talk about what exactly is happening here, because you have the president putting out a memorandum, as you were just alluding to. This is an order that cites President Biden's order that had prohibited the U.S. Steel acquisition. Trump now asking for a CFIUS review of the U.S. Steel purchase. Now, this is super interesting, and you are seeing U.S. Steel rising almost 7% on the heels of it.
All right, and the stock, it looks like, is halted right now, so we'll continue to report on that. Coming up, former New York Fed President Bill Dudley says stagflation is now the best-case scenario for the U.S. economy. He joins us next. This is Open Interest. All right, let's get a check on these wild swinging markets right now. We see the S&P 500 down 1.33%. Of course, it's been down more than 4% today and then jumped up more than 3% momentarily. So a ton of volatility, and I think that's pretty much expected. You can see there's the Dow Jones Industrial Average. Love to see it. Love to see it. 17,247, if that means anything at all to you. Then VIX has been up to 60 at one point today, right now trading around 50. So obviously volatility is serious. Let's talk about the economy, though. Separate it for a moment from the markets. Stagflation is now America's best case scenario. That's the latest from former New York Fed President Bill Dudley. In a Bloomberg opinion column, he writes, "Don't expect the Federal Reserve to rescue the U.S. economy from the epic tariffs. The combination of slower growth, higher inflation, and a stubborn Fed won't be good for stocks. It's a no-win situation." Bill Dudley joins us now. So, Bill, is this why Jerome Powell was so milquetoast on Friday? Is it just that there's nothing he can really do?
Well, obviously he can do something, but the problem is that they're going to be missing on both sides of their dual mandate objectives. Inflation is going to go up, growth is going to go down, the unemployment rate is going to move up. And so the question is, how do you balance those two things? I think it's more difficult to balance in the current environment because the Fed has been missing its inflation target to the upside. This will be the fifth year in a row that inflation will run above the Fed's 2% objective. And in that kind of situation, Fed has to be awfully concerned that if they try to follow a too friendly approach, inflation expectations become anchored, and we're back like the experience that we had in the 1970s under Arthur Burns. If you remember, in the 1970s, we had these two oil price shocks. Oil prices went from around $3 a barrel to 10, and then from 10 to around 30. And these supply shocks were different because they were persistent. I think the situation today is similar in some respects because I think tariffs are going up and they're going to stay up for quite a long time. So it's not like a temporary supply disruption like we had during the COVID pandemic.
Now, one question I have, to your point on the COVID pandemic, you had the Fed step in drastically. For the market watchers who are market participants, frankly, who are hoping for the Fed to step in, potentially even with an intermediate cut, what do you tell them?
Well, I think the COVID pandemic was quite different, right? Because COVID pandemic was bad for growth and was pushing down inflation. So it also caused massive market disruption, especially in the U.S. Treasury market. So the Fed had reason to respond, both because of their dual mandate objectives, but also because of market dysfunction. Now, obviously, if the markets start to break down in some fundamental way where liquidity, just starts to dry up, then I think the Fed might have to do something in terms of market intervention. But that's different than the monetary policy choices. And I think what Powell was saying on last week was, we have to concentrate on both sides of our dual mandate objectives, both inflation and unemployment. I mean, one way to look at this is the Taylor rule. The Taylor rule basically is a way of encapsulating how the Fed takes both inflation and unemployment in perspective. So let's imagine 6 months from now, inflation's 5% and the unemployment rate is 5%. In that environment, the Taylor rule would tell you that the federal funds rate should be about where it is today.
Yeah, so there you have it. I do want to go back to what you were saying about, market function, because that's what we've been on the lookout for. When does this become a disorderly sell-off? And, as you mentioned, I mean, there's still capital available, but at the same time, you're seeing corporate borrowers step back from the bond market. I believe we didn't see any new issues on Thursday or Friday. You have a lot of worries here that credit spreads could widen. And I mean, you are seeing IPOs and M&A deals get sidelined here. But what does disorderly look like to you, Bill? And what would it need to look like for the Fed to actually really take notice here?
Disorderly is not that market prices go down. Disorderly is when markets stop functioning, where basically bid-ask spreads widen out, liquidity dries up completely. The kind of situation where you have, a true market event is like what happened following the Lehman failure in 2008, or what happened during 2020 with the Treasury dash for cash. The markets just stop working. That's when the Federal Reserve will intervene. If the markets are, still making prices and buyers are getting matched with sellers, even if the prices go down significantly, that's not going to bring the Fed in.
Bill, you mentioned before you think that tariffs are here to stay and at relatively high levels. Others have said, I think Elon Musk, talking to some conservative group in Italy, recently said that he hopes the EU will bring tariffs down to zero, and then we will as well, and we'll have some kind of free trade zone. I'm not sure if he's still privy to the way Donald Trump thinks about things, but is that at all likely that everybody backs down to zero, that this is just a negotiation tool?
Well, the funny thing about that argument is that the European tariff levels are actually right now very low. The reason why Trump has hit them so far is because we're running a trade deficit with Europe. It's not because the tariff levels are high. President Trump has also argued that the value-added taxes that the Europeans impose is somehow unfair to the U.S., even though the value-added taxes are imposed against all goods that are sold in Europe, not just U.S. imports. So I don't really understand what the Europeans can do to make President Trump happy with them.
I was very confused about the value-added tax story also over the weekend, because what are they supposed to do? Take away their domestic taxes? I mean, Bill, another question I have is not just about European taxes, but U.S. taxes. To the extent that there was a market that was hoping for relief when it came to taxes, you're looking at a Congress that's still quite divided on this issue, and frankly, a fiscal situation that looks pretty bleak, and you have already a rating agency coming out warning that this could become a bigger issue. To the extent you have equity analysts now looking at repo rates overnight, I mean, you're getting to a level where people are starting to worry about funding stresses forming in this market. To what extent are you concerned about it, particularly as budget and tax discussions start to take the front seat going into the coming months?
Well, ironically, of course, the fiscal situation in the short run is improved, at least on paper, because the tariffs have gone up dramatically, and that's going to raise quite a bit of revenue. And then the question is, how does the Congress respond? Do they spend the money? Do they recycle it back to households and businesses, or do they actually book some of that to bring down the budget deficits? Part of the problem here is that this is not synchronized. The higher costs from the tariffs are going to occur before Congress cuts taxes. And so the near-term impact is going to be negative for economic growth.
That is former New York Fed President and Bloomberg opinion columnist Bill Dudley out with a column this morning. You should not miss it. Of course, it discusses that potential for stagflation. And speaking of large voices in the market today, earlier I had sat down with Tabak Capital Management founder and CIO Boaz Weinstein. It was in Atlantic City on an episode of an upcoming series on gaming. But during it, we asked about the probability of a severe recession. He sees that probability as quite high. Take a listen.
You cannot throw away the real possibility that it is a severe recession, because there's so many changing parts and retaliatory moves, and Smoot-Hawley it was not the cause of the Great Depression, but it certainly accelerated how painful it was. And so I think about it in probabilistic terms. We talked about the probability of recession. There's also the severity, and the tails for how bad it can be are much fatter than in my prior experience when I was thinking about a slowing economy.
What does a severe recession look like in your view? What happens in that scenario?
My world's credit spreads, investment grade, so let's just take investment grade, which it was just 50 basis points using the liquid credit derivative index. It had never really been since 08 lower than 48. We were at that kind of level, or 45. In the last few days, it spiked up to 75, but it's still very low. If I take the last 6 recessions, the range of how bad it got was 110 to 275. And if I go back even further to 2002, because these youthful looks should not convince you otherwise. I was trading credit in 2002. I was trading credit in 98. Because of Enron and WorldCom, and that was its own thing in 2002, investment grade got out to 300 or 400 basis points. And so when I think about where they were only at 75 now, the roll down the hill, the avalanche, has really just started.
You're going to be able to check out more of that conversation on Bullish, my new series for Bloomberg Originals coming later this year. Katie.
All right, let's get back to these markets right now. The S&P 500 now firmly lower by more than 2%. That big tech rebound that we saw maybe fading a little bit. Let's get into it with Bloomberg's Isabel Lee. Take me to what's happening with Apple.
Apple is down around 3%. So we basically have Wedbush cutting its price target to $250 from $325. And Dan Ives, which is one of the biggest tech bulls, cites the Trump administration's tariff policy. So he said that the tariff economic, quote, Armageddon unleashed by Trump is a complete disaster for Apple, who really sources a lot of its products from China and Taiwan. Recall that the current tariff with China is around 54%, and for Taiwan, it's around 32%. So those two will really be devastating for Apple, its cost structure, and ultimately its consumer demand. And Apple shares are now edging at around 180, so it's still quite a ways to go. But still, here's the catch. He still rates it as an outperform. So still some tinge of bullishness there.
In terms of movers that we're watching, Dollar Tree is up there, and I noted today that company's lost half its value over the past year. I think they rang the bell at the NASDAQ today. What's the story on the jump that we're looking at?
This is interesting. I was excited about it because Citi basically turned bullish, and Dollar Tree is edging around higher by around 8%. So they're anticipating that the higher across-the-board tariffs will be positive for the discount retailer. And this is interesting because it kind of bucks the narrative. Citi is saying that we think Dollar Tree has covered to increase their base price in this environment. So, for example, prices moving from $125 to $150 or $175 will seem inevitable, but they expect consumers to be accepting of this magnitude. I mean, it's still at least roughly $1. And he also said that the company may benefit from consumers wanting to trade down. So maybe we'll expect more visitors in Dollar Tree. He also upped his price target to $103 Dollar Tree to 76. Sorry.
Yeah, absolutely. Isabel, thank you so much for joining us as well. Katie, I know we're taking a look at the latest on what's going on in markets because, of course, we've had that whipsawing that we saw and, of course, some headlines now.
In the index, right? We saw the index that was down at one point more than 4%. The S&P then jumped up to higher than 3% and came back down.
Yeah, absolutely. And now, of course, we are taking a look at what is being reported by the administration. Any idea that might have been out there in the ether about a pause in tariffs is being disputed as firmly untrue. And so that, of course, is now being more firmly reflected in markets. You're seeing it right back down to more than 2% of a decline.
Let's just lay it out there so that we're not confusing people, right? There was the idea
There was speculation
of a 90-day pause, and it seems like it was a Twitter storm.
It was initiated by Bill Ackman. Of course, we were talking about his posts on Twitter. He suggested that President Trump should go ahead with a 90-day pause rather than implement tariffs on April 9th so that there would be time to negotiate. The White House is coming out and denying that. The S&P 500 is back to falling right now. We'll unpack it a little bit more in our next block because coming up, President Trump and his team hold firm on tariffs, as we've been talking about, as world leaders wonder if the president even wants a deal. We'll discuss next. This is Open Interest. Welcome back to Open Interest. The White House is disputing that a pause in tariffs was on the negotiating table right now. Just to bring you back into the back and forth, there was speculation that perhaps the administration was considering a 90-day pause on April 9th. Rather, that was the date that was supposed to be when tariffs are implemented. That is still the date, according to the White House. Again, speculation that Kevin Hassett suggested that this was in play. The Trump Rapid Response X handle said that Hassett did not say this, calling that report fake news. That explains some of the whipsaw that you've seen in the S&P 500, currently down about 0.9%. But let's stay on politics because joining us now, I'm pleased to say, we have Matthew Bartlett. He is Republican strategist and a principal at Darby Field Advisors. And Matthew, it's really hard to know where to start, but let's begin with, I suppose, President Trump's mandate, because one of the things that he said on Air Force One over the weekend was that this was one of the big reasons I got elected, talking, of course, about his trade policy that he's put in place. And it seems like his view is that what we're seeing in these markets right now is basically collateral damage.
Yeah, Katie, and I'm here in New Hampshire. I'm right off of Main Street. So all eyes are on Wall Street, but there are ramifications and repercussions being felt very much so in the everyday lives of Americans, even absent the stock market. First term, Donald Trump, I was there. I was a member of the first administration serving at the State Department. We saw historic highs. We even implemented some tariffs on China specifically. I've talked to former colleagues, some who worked in economics at the White House. Those that were in the first term, tariff hawks, now appear to be tariff doves in comparison. Donald Trump was now just reelected on, again, a populist movement, in part to end wars. I'm not sure starting a trade war is in anybody's interest. So how this plays out over the next week will continue to have massive consequences potentially for the midterms as well.
Isn't his base behind him on this? I mean, aren't Trump voters, at least the ones that I see on Twitter for the most part, say this is why we elected him, to put big tariffs on our trading partners and get rid of these trade deficits? Is that not the case, Matthew?
It's mixed. Yes, there are some, certainly pronounced online, that believe in this biblical economic theory where we will create this giant flood, and then there will be a dove and a rainbow and just prosperity and a manufacturing renaissance and Shangri-La at the end of the rainbow here. It is unclear if that happens, but right now we're also seeing communication that is more than disorganized, somewhat even disgraceful, to have this massive reordering of the domestic economy, even the global economy, and to not have a clear concept as to what this is. Is this reciprocal? Is this a fair trade? Is this manufacturing? Or is this something different? Is this about deficit reduction, eliminating the income tax and a new system of taxation? It seems as if no one truly knows, what this is, or even more importantly, how this ends. As we just saw last hour, people are looking for an off-ramp.
How this ends, I want to go right there with you, because the big question is, when does the Trump administration blink? To the extent that you see Main Street getting the hit hard from inflation potentially that might not be seen until a little later this year. Same goes for a potential recession. At what point do you have the Trump administration looking and saying this pain is too much for the country to handle?
That is the right question that everyone is asking, and it is very unclear what that answer is. Donald Trump is a rare bird in American politics, has been inconsistent in almost every issue, even contradictory at times. There's energy to that. There's upside to that, changing your mind. Yet, he has been consistent on tariffs since the days of Ronald Reagan, since the 80s. He seems adamant that this is not a negotiating tactic. This is the new global economy, this America First economy. We will see if he or his team blinks. As we've also heard, having Elon Musk, having Bill Ackman, those that are prominent voices on the right, online, now coming out and being contradictory to this policy, is significant. We will see if those voices grow louder in time.
Yeah, it'll be interesting to see how tones continue to change. But given that you were involved with the first Trump administration, I'd love to hear your perspective on this. Something we were talking about in our morning meeting is that the fact you had the first Trump administration, and Donald Trump seemed pretty short-term in nature, at least when it came to these markets. And now the policies that he's pursuing, a lot of this fruit, it won't bear fruit until he's long out of office. It takes a long time to build a factory in the U.S., Matthew. And you think about the reordering of supply chains, those are slow-moving ships here. So it seems like he has this much more long-term focus now. I wonder if that's just a function of the fact that, theoretically, he wouldn't run again, but even that is in question.
No, Katie, you said it perfectly here. We had a first term where, again, the middle class did well. Unemployment, all-time lows. Wages were moving up. Every sector, we unleashed the American economy. Tax cuts, energy, deregulation. Now, it is a far different cry. You are hearing we need to have this pain in order to serve a greater cause. America does not need cheap products. It seems shocking compared to the first term. And again, these are the voices now. This is the rationale now, but it is very unclear. We've seen in history how this notion of sacrifice for bad policies don't tend to end well.
Matthew Bartlett, thank you so much for joining us today. Matt Bartlett there of Darby Field Advisors. Let's get a check on what's going on in markets right now as we continue to see a seesaw effect here. The S&P 500 is still down 1/3%. As I said, it's been down more than 4 and up more than 3 today. The NASDAQ is currently trading green, and the 10-year yield is up at 4.1206. This is Open Interest.
Now let's get a check on these markets because we are looking at another set of green numbers on the S&P 500. If you look under the hood there, it's interesting. Most sectors are still in the red, but you are starting to see some, like financials, turn around. The Magnificent Seven, about half the components are in the green, which will show you a NASDAQ 100, now up 1.2%. Blink and you might miss it, guys, because the movements have been sharp. You even said violent a little earlier. You could get really caught under these market moves. The 10-year yield at 4.13. So a sell-off in the bond market today.
Yeah, I mean, even JP Morgan with their bear case of 4,000 on the S&P 500, they did warn in that note that you could see a near-term reversal. You also had Max Kettner from HSBC make a similar point that we could see a little bit of a bounce back. We're seeing it at this moment, but of course it's been incredibly volatile intraday, and the VIX back with a 46 handle, Matt.
You know what I think is the most interesting? When we saw gains over the past week or two, we saw healthcare, utilities, real estate, staples rising.
Yeah.
And real defensive purchases, right? But now, if you look at the breakdown, and here it is, thank you very much, Joe, we see communication services, which is like the hyperscalers, right? You see IT, the tech stocks. You see financials, Discresh.
A little
Discresh putting up some gains.
A lot of that is Amazon, though.
So that is a fairly positive signal from this market, although I'm sure we'll continue to see a volatile session. Coming up tomorrow, Matt Miskin of John Hancock joins us, Karen Pye of Fiduciary Trust, and the CEO of Snap-on, my favorite tools. Nick Pinchuk joins us. This is Open Interest.